Hello again, and welcome to the Risk and Accounting Advisory Podcast. I'm Garrett Buckless, and I am the domain leader for the accounting transformation practice at Cherry Bekaert. And today, our team is going to discuss 5 pressing issues affecting cannabis companies and ways to address these issues. Today, we are having a crossover episode. With me today are Kirstie Liberatore from Cherry Bekaert's technical accounting practice and Corey York from our accounting transformation practice. Kirstie, could you please introduce yourself and talk a bit about the type of work you do in technical accounting?
Hey, Garrett. First and foremost, thank you so much for having me on the podcast today. Really happy and excited to be here. I'm a director in our technical accounting group and a longtime Cherry Bekaert veteran. I started my accounting career here as an intern, actually, in our Tampa office, and did about 4.5 years down there in our external audit group before moving up to Nashville in 2018 and switching over to our advisory group. So our technical accounting practice can be broken down in really 3 main buckets of the types of work that we do. So we help with new accounting standard implementation. We also assist with complex transactions, so business combinations, IPOs, SPAC readiness, carve-out audits, pro formas, anything really that involves some type of a big transaction. And then lastly, we operate as an on-call technical accounting and financial reporting resource for a lot of our clients. So we have a really diverse team that is skilled in many different areas of GAAP, and we have a lot of clients who just use us kind of ad hoc whenever they have something complicated come up. We found that cannabis companies in particular often lack the expertise or bandwidth to resolve complicated issues. Because it's such a new industry with a lot of regulation, these companies get into some very complicated accounting. Oftentimes it's unique to the industry, whether it be 280E tax related or having to get creative with some financing, and there not being a lot of precedent for it. Additionally, many of our clients have experienced significant growth in a short time, and their accounting function didn't match the pace. So we've helped cannabis clients with everything from IPO readiness to inventory process to accounting standard adoption and much more. I can think of a few of my clients that have my cell phone on speed dial.
We all know that feeling. Thank you so much, Kirstie. Really appreciate the insight. Corey, I know you're a regular on the podcast, but would you mind introducing yourself and talking a bit about your experience consulting with cannabis companies?
Yeah, thanks, Garrett. It's great to be back. I am a CPA, but I did 20 years in industry and only 2 in public. I had a variety of corporate roles encompassing tax, research and development accounting, investment analysis, inventory, internal audit, even consolidations and FP&A. But with respect to cannabis, I've helped several clients in various capacities, most often in inventory controls and drafting and evaluating inventory counting policies and procedures. In college, also, I had many peers who served occasionally in the capacity of clientele for the industry.
Thanks, Corey. As I mentioned in my intro, today's conversation, we're going to discuss 5 issues impacting cannabis clients and how to address these issues. Our aim is to highlight these issues currently affecting our clients, discuss their root causes, and how our teams have helped address them in our experience. Kirstie, can you kick off the conversation with your first pressing issue?
Sure, Garrett, thanks. So I'm going to try to do this without getting too technical on you guys. But as we all know, or at least those of us that work in the cannabis industry, cannabis companies have always struggled with access to capital, especially in the US because they're not allowed to trade on the stock exchanges here because operations are still federally illegal, even though many states have made it legal in some way, shape, or form. Federally, it's still illegal, and therefore you're not allowed to trade your stock on the New York Stock Exchange or the NASDAQ. So because companies cannot list on the US exchanges, they generally go over to Canada and list on the Canadian Securities Exchange. And that's because I think it was around 2017 or 2018, Canada made cannabis federally legal. So they're allowed to actually trade there, and that's where many of our bigger clients go for access to capital. But what is different about the Canadian exchange is that from the U.S. exchange is the accounting standards that they have to file their financial statements under. So the CSE requires the use of IFRS, whereas the U.S. exchanges all use U.S. GAAP. Where this gets a little technical, and again, forgive me, I'm going to try to keep this as simple as possible. Typically, most companies initially qualify as a foreign private issuer when they trade on the CSE. And what that does is create certain exemptions and accommodations from the stricter reporting and compliance requirements applicable to U.S. domestic companies. So the primary reason to become an FPI is so that you can go public without an SEC registration statement, and you also don't have to apply Sarbanes-Oxley, which we'll get into in much more detail later in this podcast. But there are certain requirements that you have to meet to qualify as an FPI, and those are tested every year. So again, not going to go into the details, but the one that trips up most companies is having a majority of your voting stock held by residents inside the U.S. So if most of your company is owned by executives of the company that live in the United States, you're going to fail that test. And the minute that you fail that test, you have to, within the same year, you have to register as a public with the PCAOB. So when that happens, you are immediately faced with a bunch of accounting issues. One, as I mentioned before, your financial statements aren't in IFRS and they need to be converted to GAAP. Two is getting a PCAOB compliant audit opinion, which is a much heavier lift than a regular private company audit opinion. And then three are all the SOX issues that come with it, whether it be 404A or 404B. And again, we'll get into the details of that a little bit further down the road. But the biggest issue with the conversion piece is that there's two main issues that most of our clients see as it relates to inventory and leases. So any plant touching cannabis company is going to have to go through those headaches, I'll say. Okay, so now all of a sudden, these companies are faced with a bunch of accounting issues. One is converting their financial statements from IFRS to GAAP. Two is getting a PCAOB compliant audit opinion, which is a very heavy lift. And three is all of the SOX related issues that come with that, whether it be 404A or 404B, which again, we'll get into a little bit later. Cherry Bekaert has helped with all of these issues for many, many of our clients, cannabis clients. We have a lot of people who are highly skilled and experienced in the differences between IFRS and GAAP, especially as they relate to cannabis companies, where the two biggest issues relate to the treatment of inventory and biological assets and lease accounting. We also can help get your financials ready for a PCAOB uplift to be audited. Cherry Bekaert does not actually do the audits of these clients, but we can definitely operate in a consulting matter to get you guys there. And then we can also write technical memos, do journal entries, we draft financial statements, assist with the MD&A. There's really not much that we can't do other than issue the audit opinion.
So, Kirstie, I actually have a cannabis client who just tripped that test. How does the need for a PCAOB compliant financial statement drive or impact SOX compliance?
Yeah, sure. That's a great question, Garrett. So every issuer in the U.S. is required to be compliant with SOX Section 404A, even if they're not trading. So this requires management to conduct an annual evaluation of the operational effectiveness of its internal controls over financial reporting, or ICFR, with documentation of both the controls and the mandated testing thereof, and to report the results publicly in its 10K. Only accelerated filers are required to comply with SOX Section 404B, which requires independent auditors to report on the effectiveness of the company's ICFR. Non-accelerated filers are issuers with less than $75 million in public float. We have a strong SOX team at Cherry Bekaert as well that can help with both 404A and 404B compliance. They can assist with everything from creating risk and control matrices to writing narratives to actually functioning as the internal audit department and ensuring 404B compliance.
Corey, I know you're well versed from your intro you mentioned IA. Can you talk about why this is such a hurdle and some common issues becoming SOX compliant?
Yeah, sure, Garrett. So SOX above all requires structure, discipline, and process. Requires you to spend time in administrative planning and scheduling, status checking, all for what could be perceived in a fast-paced, high-growth environment as a non-value-added activity. Identifying like the best and most appropriate control owners can be challenging in those sorts of environments. Not even specific to cannabis, right? Company and culture in a growth industry that's moving fast and breaking stuff, in the parlance of our social media times, might find like the structure that's inherent and necessary to proper SOX compliance, the testing and reporting therein to be confining and difficult. They can also find themselves working up against a proliferation of IT systems. Could be old ones, could be new ones, that may or may not be up to the challenge of promoting effective controls. And all of these factors can lead to compliance that is half-baked.
Thanks, Corey. Kirstie, what are some other complexities associated with becoming a public filer?
Yeah, so I think the biggest one that is specific to cannabis companies is finding a competent auditor, right? So just like every other vendor that is difficult for cannabis companies to work with, audit firms are no different. So most of the big ones, all of the big four, most of even the top 10 firms, I'll say, will not issue an audit opinion for a cannabis company just because it's too risky for them. That leaves them with few options. A lot of the Canadian firms will do it, but they're not as skilled in GAAP. And there's one large US firm that does it, but a few $100 million revenue company, and you're limited to auditors that aren't necessarily as skilled as you would like them to be. It just makes everything a little bit more difficult.
Corey, can you talk about the next issue facing cannabis companies, which is something near and dear to yours and my heart, inventory?
Yeah, for sure. I mean, a common issue among anyone who has manufacturing, but especially cannabis companies, is inventory. It's the lifeblood of the company. So how do you properly count and value it becomes a question. And counting and valuation go hand in hand. A company that cultivates and processes their own vegetation has to painstakingly monitor their crop and their yields. And there's a lot of record keeping to properly cost inventory and properly cost it in the appropriate period. Every plant and recipe has different yield, potency varies. It can be a pretty heavy data lift to make sure that those assumptions that are baked into the inventory and the way that the inventory is valued are accurate and then remain so over time as methods change. I'm just throwing ideas out there as fertilizers may increase yields, or differing production methods decrease the amount of product that you can get from a given set of ingredients. Accurate counting is critical to valuation also, because it doesn't do you any good, as a manager, to have an incredibly precise unit cost and then no idea how many units that you have on hand. And this is just costing type information. Like, it's not even to mention the inherent street value of the products at every phase of production. And now this may shock you, but there are those who insist on getting high from their own supply, and more accurately, their employer's supply. Most people don't know this. It's sad. But shrinkage is a real concern. So like proper security measures are paramount. And in many cases, there also are some legal regulatory precautions that need to be taken with respect to the way facilities are designed and able to be accessed as well. And we've worked extensively in this area. We shore up policies and procedures for financial supporting period end counts. We've helped design and develop daily, weekly cycle counts, monitored KPIs and root cause corrective action style investigation. Just merely writing things down at times, writing down the protocol of the way things are done and sharing across entities in many cases is enough to increase some count accuracy and improve and replicate best practices. There's no substitute, however, for tone at the top, leadership that prioritizes and focuses on continuously improving your count procedures, be they month end or daily.
Thanks so much, Corey. Kirstie, what's next on your list?
So we all know that the cannabis industry in the U.S. has absolutely exploded since the first states legalized adult use marijuana in 2012. And then again in 2018 when the Canadian government passed legislation legalizing it across the nation. What that has done is created a flurry of M&A activity. So we've got everything from venture capitalist firms to corporate M&A, and even now we're starting to see private equity jump into the mix. So that's created some additional complexities for cannabis companies.
And Kirstie, how does M&A activity drive complexity for a cannabis company?
So the biggest issue is around the valuation of these entities. And there are a handful of challenges that are created because of the industry. First and foremost, there are no true valuation counterparts against which valuation criteria can be applied because cannabis is such a new industry. So there's just not a lot of comparables out there. The industry also still faces uncertainty around legalization and regulatory matters, which further complicates getting a good valuation. And then also the complexities around state regulations and market size within the state. So this is a unique industry where every state almost operates in its own ecosystem. So states on the East Coast are typically more restrictive. A lot of them are just medical use, or they're medical and adult use, but there's not unlimited licenses, where the states in the West Coast, like Colorado, Oregon, and California, there's not as many licensing restrictions. So it's a lot easier to get a license out there, but that changes the nature of the valuation of a company, whether it's in Florida or if it's out in California. So typically you would get a higher valuation on a company that's operating in a state where licensing is more difficult to obtain. Additionally, something kind of crazy happened in the second half of 2019 and leading into 2020, and US and Canadian publicly traded companies started experiencing a lot of market turmoil amid concerns over vaping and continued uncertainty around US federal regulation. So declines in market cap resulted in public cannabis companies significantly slowing down M&A activity. However, despite that downturn, we're still seeing the large MSOs being highly acquisitive, right? So in 2021, I think it was October 1st, 2021, we saw the largest cannabis acquisition in history with Trulieve purchasing Harvest in a $2.1 billion deal. Earlier this year, Cresco Labs announced the purchase of rival MSO Columbia Care in another $2 billion deal. Curaleaf, Green Thumb, Ascend, all of those big MSOs still continue to acquire smaller companies at a rapid pace. So one thing that's different also about the cannabis industry is that the majority of these companies are being valued based on multiples of revenue rather than the traditional EBITDA. And these valuations vary widely based on the state and vertical in which the company operates.
Right. Thanks so much, Kirstie. I'd seen some of that myself, but I appreciate you diving so much into that. That was really helpful. Corey, what would you like to discuss next?
Well, I think we could discuss issues that are unique to cannabis companies around the institutions and the structures that exist. Kirstie talked a little bit earlier about the federally illegal, but at a state level, various levels of decriminalization and destigmatization. That non-federal model has consequences. If you think about state-to-state differences in product labeling, marketing, and even like delivery methods, they differ from state to state. What's legal in one could engender fines in another. There is a patchwork of IT systems that are in play as each state can select what different required regulatory or tracking software they mandate businesses to use in order to enforce state-specific regulation. A multi-state operator, has to consider all that, and they have to manage that ever-proliferating portfolio of systems, and be able to reconcile those to any central ERPs or any other, bolt-on software that they utilize for normal management. Being nominally illegal at the federal level, Kirstie talked about financing, but even something as simple as your day-to-day banking. Lack of banking access means that a lot of these businesses have to run solely on cash, and that's for purchase. For in the case of a retail location, that could be cash purchase of wholesale vegetation, or the dispensary receiving funds from a patient at that level, handling, tracking, storing, depositing large amounts of cash. It's a relatively unique industry. It's a unique issue for an industry that's in so high of a growth mode. Just to give you an idea, one state that's been legal for some time is Colorado. So 13% of Coloradans, per the 2020 era census, it's about 800,000 people, are cannabis users per their Department of Health. Average per capita spending in Colorado is over $250. So you can see that adds up really quickly. And you'd be surprised how much cash is in the vault of, an unassuming store that's the size of a family video. And for Gen Z listeners, that was where we went to rent that was where we went to rent terrible Hollywood products before the internet allowed you to stream them in your own home. But more about sort of the state-specific rules. Before I mentioned like the packaging and delivery laws differing. For example, in some states, medicated product must carry like certain additional labels and warnings, almost treated something more like tobacco. And in other states, only certain delivery methods are legal. Some states, I think, prevent certain potency of vape cartridges. So there may be additional restrictions on things like edible products, and it varies literally from state to state. And Kirstie also mentioned sort of each state being its own ecosystem, its own cannabis universe. It's similar to insurance as well, in that you can't cross state lines. You can't relieve an inventory shortage with surplus from another state. It's federally illegal, and you can't ship it across state borders. So that creates other issues, because you can't use a one-size-fits-all approach with your businesses if you're a multi-state operator. In one state, you might be seed to sale, you might grow it, process it, ship it, and sell to cannabis patients. In another, you might have a growing license that you have a greenhouse, but you don't have retail. Or you have a retail store, but you don't have a processing license. So that requires a different mindset and set of controls for each stage within the production and sales cycles. So those are a few of the institutional and structural issues that are sort of unique to the quasi-legal cannabis company.
How does cannabis being a relatively new market impact companies trying to operate within the industry?
So there's no leader, there's no Coca-Cola to copycat. There's no Tesla, like with electric cars. Tesla, they had to prove it was a viable market. And then now some well-funded and subsidized competitors start entering the fray once that's established. And so that segues pretty well into my last couple points on this topic, which is like the lack of institutional knowledge. You got a high growth market, and you don't have any gravity from that clear industry leader. So the competition for talent becomes pretty fierce. And, we harken back to those state specificity. Some states have lengthy background check requirements to even work in the industry. And a new hire can basically turn to vapor when they get a visit from the better offer fairy, and they can leave for a job that lets them start immediately, rather than a cooling off waiting period while they make sure that they're okay to work in the cannabis industry. Those regulatory hoops to jump through for hiring, they can be onerous in a way that like a federally legal business wouldn't need to, they wouldn't necessarily have to deal with. You combine that with the volatility of the industry, so it adds up to a lot of businesses vying for that same pie, trying to pick each other's pockets for talent, so to speak. Even larger companies, some of which are our clients, are unable to, shall we say, bogart the labor force effectively. There still is some fear, even in states where they have full decriminalization. There's a fear of some like stigma being attached to having a cannabis company on one's resume. And that can lead to some employees exiting a given firm or failing to make it a long-term career.
I think that's something that's facing a number of our current clients. What makes cannabis so unique?
Well, the specialized knowledge therein. I mean, to a degree, every profession is a conspiracy against the laity, right? But with the covert nature and the stigma attached to knowledge of cultivation and processing cannabis until recently, it presents another difficulty for the industry. Even now, the chemical expertise surrounding cannabinoids and genetics of the plants themselves, it's not like you can't find that as easy as you could as like a machinist or like a Python programmer, right? Very, very few post-secondary schools even offer horticulture classes, degrees with like a cannabis focus. It's grown since, but in 2020, there were only 2 accredited universities that offered a 4-year degree in cannabis science. So there's a few more now, but that just shows you like how rare like a accredited background in the industry is. And like in any company on an upward growth trend, we recommend structure, regularly reviewing your procedures, documenting your protocols in all areas, not just inventory and finance, although that's my forte, to make that onboarding easier, to make cross-training more effective. It makes you less reliant on individual heroics and folks who may not hang around as long as they would in a equivalent industry. So you got the lack of specialized knowledge. You can also deal with a lack of focus, a lack of common goals. I mean, I know there's one thing that's never associated with cannabis, it's lack of focus and direction. But seriously, that's something that's not actually particularly unique to cannabis. When things are volatile, like the industry is currently, dealing with gradual falling of regulatory barriers, that can be an irregular and sudden process. Potency arm races, thirst for new products, since the level of competition is so high. All of this, I say all this because it's important for the tone of the top at the top, to establish what themes you can that can easily apply across states, across for new acquisitions. For newly vertically integrated subsidiaries, that while you might not be able to detail a theme and a policy down to an individual area specifications, like providing general guidance on foundational matters, allowing some autonomy for local management to interpret, to be able to run their business according to their unique set of regulatory circumstances and customer bases and so forth. That tone at the top can go a really long way. We, for example, we've helped a client establish a rotating schedule of policy reviews to make sure that the company brass still is in agreement and focused on what a given policy is intended to promote. We've helped, on the tactical side, the operational side, we've helped mix in regular drop-in type observations with another client where we perform actual testing and we assess procedures regularly related to inventory and fixed assets or cash even. And we've seen some significant improvements in count accuracy and month-end valuation accuracy at locations that we've just visited to provide simple bullet point observations and recommendations on how to address them.
Kirstie, can you take the final issue we decided are facing cannabis companies?
So the last issue I think that's worth noting today is the complexity that's created around leasing and financing transactions for cannabis companies. As we've mentioned several times today, it's not a secret that these companies have difficulty obtaining traditional financing. So as a result of that, they often have to get creative or accept arrangements or terms that are not really advantageous to them. So, high interest rates, high monthly payments, longer leases, you name it. They kind of have to accept what they can get because they just don't have the options that a normal company would. So this can create some unusual accounting scenarios. There's 2 real buckets here that I think are worth noting. The first is around lease classification. So what would typically be an operating lease for pretty much any other industry as it relates to vehicles or retail space or, equipment, sometimes, or actually oftentimes, end up being classified as financing leases for cannabis companies, just because they get such bad terms that the payments are so high that they trip some of the finance lease classification issues. Why this really matters for these companies is because finance leases are classified differently on the balance sheet than operating leases. They have different geography on the statement of cash flows, and it impacts EBITDA differently than an operating lease would. So when our clients are going out to do their earnings releases, and I'm getting calls at the 11th hour from the CFO saying, why is this vehicle lease a financing lease? It's messing up my numbers. And, we just have to explain like that. Essentially, like that's you just got bad terms. Kind of knowing that going into it is always helpful. I try to preface that with my clients now. Hey, you're not going to like the way that this kind of shakes out in your financial statements. The other big issue as it relates to these types of transactions is the accounting treatment for sale leaseback transactions. So a lot of these big vertically integrated MSOs will sell a building that they own and then immediately lease it back to try to get financing. So they're either trying to finance the build out of a cultivation or manufacturing facility, or they're using the proceeds to pay off other debt because they don't have access to traditional loans. Either way, whatever the reasoning, they also get bad terms on these lease back deals. And again, without getting into too much technical jargon here, with the adoption of the new leasing standard, the accounting treatment for these types of transactions changed significantly. And many of these transactions now are ending up as what's called failed sale leases, which you don't have a lease on your balance sheet anymore, you have debt. And it's called debt and it's classified as debt. And, that again, can sometimes be a little bit of sticker shock for the executives at companies who are like, this is a lease, why are we calling this debt?
Kirstie, and how have you addressed these issues in the past?
Yeah, so we have seen it all when it comes to the leasing standard with cannabis companies. We can assist clients with assessing the classification criteria, which, by the way, for these large organizations can be an extremely heavy lift. We have some clients with over 100 retail operations and hundreds of vehicles and tons of equipment. So when you have to go in and assess each individual lease for classification, that can be a heavy lift, but it's something that we can do quickly and we can do well. We also can help identify leasing software to streamline the monthly accounting and analyze, calculate, and document the accounting treatment for sale leaseback transactions. So, like I said, we're kind of a one-stop shop when it comes to the leasing standard.
Thank you, Kirstie and Corey, so much for joining us today. And thank you everyone for listening. Hopefully we provided a little bit of insight into common issues facing cannabis companies and how to remediate them. At Cherry Bekaert Accounting Advisory, our practice is focused on solutions designed to increase productivity, reduce costs, and improve reporting quality. For more information on this topic or how you can approach accounting advisory for your organization, please visit cbh.com. Please like, share, and subscribe to the Risk and Accounting Advisory podcast, and thanks again for listening.